right, good morning, everyone. Today is November 30th, 2022. It's the last trading day of November 2022. And I hope everyone had a good Thanksgiving. I took a little time off for Thanksgiving, didn't do a show, had a lot going on, but so I hope everyone enjoyed that. We're headed into the holidays now, and there's there's well, everything's kind of on the fence post right now as far as the market, which we'll take a look at here in a minute. So it's going to turn out to be an interesting year, especially because, we have one more month. So Christmas is right around the corner and New Year's and all that. 2022 is almost over. As of this morning, the three major indexes, the Dow started today only down about 6% for the year, roughly. S&P down about 16% on the year, and the Nasdaq down about, oh geez, 20 something percent, mid 20. I forget what the number was, but anyway, so it's kind of odd. The Dow only being 6% off of the highs is pretty amazing. S&P is typically what I refer to as the market, and it was down a little over 25% at one point, and it's rebounded quite a bit, but we'll take a look at that in a minute. So today, Jerome Powell speaks at, I believe it's 1:30 in the afternoon, so the market's kind of, you know, probably going to be sort of on hold. There was some jobs numbers out this morning, and so everyone is fixated on several things. One of which is inflation, obviously. One of which is, what is the Fed going to do in December? Because they've basically said that obviously they're going to raise interest rates. And so the big question is whether it's 50 basis points, 75 basis points, and then I think, it's already sort of baked in, but what's important is what are they going to do in the new year? Are they going to pause? And the GDP number came in, and it was something like 2.4% or something. It's hard to keep all these numbers straight, but anyway, and projected GDP for, I guess, this quarter is like 4.6% or something. So anyway, it's all about the interest rate hikes, the terminal rate, all that good stuff. And of course the Fed has been sending a lot of mixed signals, but and then of course whether we're going to enter a recession next year. So anyway, lots of macro stuff floating around there. I found this I found this somewhere on the internet, the inflation rate for all of these past years, which I thought was fascinating, right? And so, um, as you can see, like I added the last couple of numbers here, right? Because it was, I guess it was in August or whatever. I don't know, but anyway, I found this and I decided, well, hey, this would be kind of cool to have handy and to keep up. Because, well, just because I almost like this better than I like the graphs that show the inflation rate, because this is just a little bit more. It's easier to look at, honestly. It just kind of stands out, and so the important thing, obviously, and this is the crazy part, is this last number. This is the CPI, right? The official CPI. So this very last number right here at 7.7% inflation rate beat the expectations, and quite frankly is one of the big contributing factors to the current rally that we've seen off of the lows, which seems insane to me because 7.7% inflation rate is terrible, but it beat the expectations, which were like, 7.9 or 8% or whatever. So This, the very next number here, and so here's the other thing is the the rate has been coming down, right? So you got it, I guess it peaked there in June. That was the peak, 9.1, and then you can see each of the subsequent numbers have come down just a little bit. So when the next CPI number comes out, that's going to be really interesting to see if, and nobody really knows because there's so many cross currents, right? The price of a lot of stuff has come down considerably. The main thing, to me anyway, the main contributing factor is the price of oil, that trickles down into CPI. However, um, they exclude food and energy, right? The Fed's focused on the core PCE or whatever. So anyway, all that aside, whatever Powell has to say today is definitely going to move the market. So there's a couple of spots look at in a second here, but there's a couple of spots on the chart where the market was attempting to, stage a really good rally, and then Powell, came out and spoke hawkishly and totally torpedoed the market, right? There was a couple of spots right there, I believe, right there. Anyway, the reason that I have this chart up like this is because I wanted to point something out, which is kind of interesting. And so, the chart's a little bit squished down here, but the MACD on this, is in a really interesting spot. So this is the SPX here. Interestingly enough, if you go back to the very beginning of the year, there we go. Let's see if I can get, I want to get 2022. There we go. There's the whole year, right? 2022, right there. 2023. So as you can see, we have 1 month left. The market's been very cyclical this year, right? So this MACD kind of rolled over here in early January, and that was the first leg down, right? And then, of course, it's a little noisy, but this crossover to the upside coincided with that first rally. And then, obviously, right there, rolled back over. That was the next down leg. So I think you get the point there, right? This was the big summer rally here, but that MACD crossed down, and we went down and hit another low. And so the point of it is, there's a couple things. One, you can see the 200-day moving average is that blue line there. And, back in August, it literally came up and touched the downward sloping trend line, which coincided right with the 200-day moving average. And then it got turned down, to make a lower low. And so anyway, and then, of course, this day where it gapped down and touched 3,500 and reversed. That's just like was a textbook reversal day, but it was almost like the most obvious thing in the world to see that sort of a reversal, and lo and behold, it actually did mark the reversal, right? And so 3,500 was it was a big Fibonacci retracement and everything, and a lot of people sort of had that as a low, but I don't know that anybody expected that to turn out to be the actual reversal point there. So anyway, interesting stuff, but I think that this latest rally here, there's a couple ways of looking at it. One is that it could still rally up and touch the trend line like it has before, right? This trend line, the last two major rallies, I guess you'd call them bear market rallies, came up and touched the trend line. And both of them, this one broke above the 200-day, the blue line, and this one touched the 200-day. And so we haven't quite touched it yet. And so there's every possibility, I suppose, that that the market could still rally from here. And quite frankly, whatever Powell says today, I expect a fairly dramatic reaction. It seems like the it seems like the I don't know about the volume, but the participation has been down. The market's just been kind of um, I guess you call it liquidity. You hear a lot of people saying that there's no liquidity and the liquidity's down and all that, and so it seems like the market's just kind of on a day-to-day basis is almost just trading sort of in a random manner. So there's every possibility that it can still rally up, at least touch the 200-day, maybe touch that downward sloping trend line. Interestingly enough, back here, I believe it was around the end of September. Um, Goldman Sachs lowered their year-end price target to 3,600, right? And the funny thing is, so there you go, year-end price target 3,600. The funny thing about that is that at the time the S&P was still like on this down leg here. So it was somewhere in this neighborhood is where they lowered it to 3,600, and that's a long way down from here if you think about it. And so it'll be interesting to see. I mean, the only way that happens is if we roll over here and and have another down cycle, like if another down cycle starts here. But here's the thing: is typically we're in the seasonally strongest time of the year. Seasonally speaking, November and December are pretty strong for the markets, and I think Wall Street itself doesn't want to see like a big down year. He's like, so the S&P's down roughly 16% on the year, which is probably acceptable to some people. I mean, it's still a bad year, but I mean down here it's like down 25%, and so I don't know that it's in anyone's best interest for the year to end up down 20, over 20%. And so, they may attempt to push the market higher, or at least hold it around here so that it doesn't turn out to be a terrible year. I mean just the idea of the headlines from that, the headlines and the news and all that, talking about stocks were down 20 something percent in this year. But I showed you that chart a few weeks ago about intra-year drawdowns and how the market typically, most years it ends up. So most years and years following a down year are typically up. I'm sure you've seen the statistics on that. So anyway, whether this MACD cross is going to turn into another down cycle here or not remains to be seen. What would be even more interesting, see if I can adjust my chart now, because that having that MACD on there, it skews the chart a little bit on the show, but there we go. What would be even more interesting is if the market somehow managed to rally up to this trend line and poke above it, because I mean that's the that's the major trend for the whole year right there, right? And at this point here, the over and under is 4,000, and so 3,900 has been like a huge level ever since, let's see, I'd say back over here, back in May. I had a horizontal line at 3,900 because there's, just a lot of history around that level. So, so anyway, the market's kind of in a holding pattern here. It looks like it kind of wants to roll over, but let me draw. Should have adjusted my chart for these drawing tools initially, because my new thing here is I try and draw stuff on the chart while I'm doing the show. So there's this, right? There's this upward sloping trend line too, and that's pretty close. Close enough for government work. Whoop, there we go. So there we go. The market is getting squeezed into, you basically ignore this little, if this was a candlestick chart, that would just be a little tail there. But that's, that's about the best fit right there. So yeah, it's going to be really interesting to see how this pans out. If I extend that to the end of the year here, here we go. It's a little bit steeper than that. So yeah, so I mean, yeah, there's it seems very unlikely to me anyway. Seems very unlikely that it's gonna like work its way too much further towards that apex. So one of these is gonna give way, and of course, just because it breaks this trend line doesn't mean a whole lot. Because quite frankly, this would be a little bit more, sort of. That's probably a better angle on it, down here, something like that. And so yeah, it wouldn't be a huge surprise to see the market sort of, bounce around in towards the apex here and end the year somewhere in this area. But that MACD we looked at, I'm still looking at it on the chart. If it starts to roll over, if this trend line goes, well then, quite frankly, it could even make a lower low. But I think it's really, nobody knows how this is going to play out, right? A lot's going to depend on the Fed. I mean, that's the big thing. And I read an article this morning that that was basically saying, it's all about the S&P earnings, and putting a 16 to 18 multiple on, a certain amount of S&P earnings versus everybody, I think, is expecting an earnings slowdown, which makes a big difference. And so, that's the difference between between the over and under at 4,000, right? Is if the S&P earnings come in good next year, then the S&P, obviously the market will rally back up there. If the earnings come in bad, then we're looking at down here. So let's look at let's see, the Nasdaq. It's been pretty tough. I mean, for the Nasdaq, it's a whole different story. And actually, I mean, this is just the Nasdaq 100, but it's a whole different story. I mean, you got the same cyclical downtrend pattern. This current rally is a lot weaker in the Nasdaq than it was in the S&P, and obviously, a lot of the leaders, a lot of the big cap, big names. There's Microsoft, right? I mean, that's a pretty rough looking chart, quite frankly. You look at the highs over here. I believe those weren't even the highs, but go back a little bit. Yeah, a lot of tech stocks. And so that's the other thing too, is I believe funds are obviously, going towards value stocks and away from tech stocks and that. And so, I mean, the stock market is littered with stocks that have absolutely been decimated and crushed. And quite frankly, so I look through some of these big cap, big name stocks, and obviously Apple, the most important one. I look at how much these things are down from the highs, and I wonder how in the world the market is not down more. Right? I guess Apple's not down too much, but by no means is this by no means like where it is right now. And let's see. So, and of course Tesla. Tesla for a long time there was a really important stock. I mean, Tesla's lost over half of its value from the high. There's 400, there's 200, trading at 182 now. There's so many of them. But then again, there's stocks like Pepsi, right? So look at Pepsi, Johnson and Johnson. So these old school stocks, they're hanging in pretty well, which I suppose is a good thing. And so, there's always money out there that gravitates towards money that's in the market, and it just rotates into sort of safer stocks. Boeing is one that's kind of amazing to me because um, oh, now I'm into log scale charts here. So, but anyway, the one I wanted to look at was, let me find it in my list here, was ARK. Yeah, ARK is let me go back over here. I know that this is a log scale, but I'm not a huge log scale fan. I mean, okay, so now I need to fix my chart here because it's all, there we go. It got all discombobulated because I picked this out of my watch list. And so it's got a different, I don't have moving averages on it in my watch list, but there we go. Now we're getting somewhere. Yeah, I mean, this is basically a proxy for the high momentum growth stocks, the Zooms and Roku and Coinbase and all these kind of, sort of, I won't call them fad stocks, but well, maybe I should call them fad stocks. So, because I mean, a lot of those, if you think about it, I mean, they were just crazy. They were just, yeah. Oh, hey, Jim. Good to see you in here. Wow, it's been a long time. So, yeah, Apple's down 20% on the year. And the S&P's down roughly 16, 17%, right? At least I looked at the ES futures. I like to pop over to FinViz and just hit that performance chart and look at the little graph they have, the year to date, and that just makes it the easiest. Now with these charts here, like you can go to SPY, say pick a weekly chart, and you can hit performance over here. This is kind of an easy way to do it, sort of, but yeah. So the one, what I don't like about, I use these what are called like ACP stock charts. I just like them better than the old-fashioned stock charts. But there's a couple things about these ACP charts that I don't really like, and one is the scales of them. Like on certain stocks or whatever, it's hard to see exactly where something is. So I'm sure there's a lot of tricks that I can't use, but these crosshairs, yeah. So just like I said earlier, about 16% down on the S&P. And so, yeah, that's one way of seeing the performance. So yeah, if I put in Apple, um, I guess let's see, and then the other hard thing is like kind of the year to date. So I mean, there's the high. The other thing is with the line charts too. Like when you do these performance charts, it's not using the intraday. For whatever reason, I've always used the intraday highs and lows to, kind of figure out, where we are. And so I know Wall Street likes to use line charts because it's end of day, it's the close. But I'm on a weekly chart here, right? And so what I'm seeing here in Apple is the weekly close, so it's definitely not taking into account, the actual highs, but close enough, down 20% in the year. Yeah, so I mean it's pretty amazing the S&P's held up. Now there's a lot of excuse me, energy companies in the S&P, right? Which is definitely contributed to that. So, yeah, there we go. I was talking about this earlier. The Nasdaq, the Nasdaq 100 is down about 28%. But all right, well, back to what I was talking about here a second ago. ARK is, ARKK. Whoops. Every now and then I do that. Yeah, I mean this ARK is probably the best proxy for, and I'm back to a weekly chart here. This is the best proxy for high growth, high momentum, fad type stocks, and you can see what a complete disaster this is, right? And what gets me, it's interesting because they publish their holdings and their trades and this and that, but what gets me is, like, you guys, Zoom was one of their favorite stocks, and I remember it wasn't that long ago. I mean, it was earlier, maybe over the summer or something. They came out with, ARK published like this big long piece, which I glossed over, um, of why they expected Zoom to be like, they expect this to be a $1,500 stock. I believe it was, right? And so, I mean, that's kind of hard to fathom. But the thing about it is they keep doubling down and averaging down on these stocks, right? I think it was just recently Coinbase. I mean, there's Coinbase weekly from the IPO, and I remember how much hype surrounded this from the IPO, but I mean, this is just an epic disaster. I mean, it's down here. I mean, it's basically, at the lows, and just incredible amount of destruction in something like this. And so, and we looked at Zoom and what's one of the other, some of the top holdings. I haven't actually looked at the top holdings in a while, but when I look at a lot of these charts, it reminds me of, the aftermath of the dot-com bubble. I mean, this is what, in the year 2000, right, 22 years ago, you had the same kind of thing. You had these parabolic run-ups, and then it's kind of interesting because this one actually had a big sell-off and a sort of a double top, whereas a lot of them, like, a lot of them, they had the initial sell-off, and then let's see if I can pull this up here. Yeah, funny thing is, I saw a chart of the South Seas bubble of, like, 1798 or something like that. Whenever the South Seas bubble had almost an identical chart where you had a parabolic run up and then sort of a break and a little rebound, and then almost a similar pattern to this. Parabolic run up, first break, a little bit of a rebound and kind of hanging on, and then the bottom drops out and it goes back to where it started, and then they flatline. They tend to flatline over here for years. Trying to think. Let's see. Here's a good example of, well, this is probably not a good example. You remember GoPro when this is a weekly chart. Way back in the day, GoPro was one of those sort of fad stocks, right? And it IPO'd, and everything was, GoPro this and that. They talked about it incessantly on CNBC. That's how you can usually tell. Right? And so anyways, parabolic run up, big sell off and that. But I mean, for one thing, most people don't even realize it's still a stock. But this is an example of, a lot of what happened after the dot-com implosion is, they just never recovered. And so that's something to keep in mind. And look at this, from 2016, how many years is that? 1, 2, 3, 4, 5, 6. Here we are 7 years later, and this stock's just, floundering around at $5. There was it AMBA? Yeah. When I mentioned GoPro, this was a similar sort of thing. Yeah, you see, this is reminiscent of the dot-com era too. You had these big sort of parabolic run-ups and collapses, and then years would go by, and the stock would get like sort of a second wind. But the thing that blows my mind is when you actually look at the price scale of a lot of these stocks. I mean, because there's a ton of stocks that are down. Well, I mean, let's go back to Zoom, right? Because, for ARK to come out and do this huge research report about how Zoom was going to be a $1,500 stock, um, in 5 years from now or whatever. And you look at it and you think, man, you talk about going out on a limb, but yeah, SARK. Jim says SARK is SARK. There you go. What's amazing about this is this is obviously short, ARK, which is kind of crazy. But what's interesting about this is that, when it first came out, it just kept going. Like it hasn't bombed out because ARK hasn't bottomed yet. So there's a whole lot of new inverse ETFs, like ETFs that are inverse to individual stocks, which, I'll be honest with you, I'm not sure how good an idea that is. I mean, obviously it's a good idea for, traders to be able to buy an ETF that's inverse an individual stock, but in the big sort of mechanics of, the overall market, I've kind of, over the years, especially recently, you remember, when they came out with the double leveraged ETFs and all that kind of stuff, and the SQQQ and all the all the double leveraged ETFs. The problem with them is that, I mean, look at this. The problem is that, and especially the triple leveraged ones, is that they're designed to lose value over time. That's insane, right there. I mean, that's just nuts. But it's the nature of them. How it's designed to be like a day-to-day thing, right? So each day, it's designed to match the performance of just how it did that day. And then, but the expense ratios are astronomical, and then everything compounds. So, what's the one I'm looking for on the S&P? It's been a while since, quite frankly, I don't fool around with these leveraged ETFs. So I just don't really fool around with them that much or look at them anymore. So let's see, what was I going to look at? Oh, I know what I want to look at. I wanted to look at, so the big winner this year, obviously, is energy. Right. As a matter of fact, it might be like one of the only sectors that's, quite frankly, looking at weekly charts too. I mean, especially this time of year. Daily chart, like we looked at earlier, kind of is interesting, obviously, to look at. But the bigger picture is since there's 1 month, and the other thing is that the monthly charts too. Like at the close of trading today, we can look at the monthly charts, which reminds me that I want to see what this monthly chart of the S&P looks like here, because it looks to me like, oh, I don't have open, high, low, close bar. I must have picked the wrong one. It looks to me like this is going to be, well, unless Powell says something that the market doesn't like. Let me go to the SPX here. It's interesting how S&P and SPX look a lot different. So the open was 39.01, right? And so unless Powell says something that really torpedoes the market, this is going to be, November is going to turn out to be the first time all year that the S&P has had 2 up months in a row, right? I mean, obviously January, was a rough month. January and February, both down months. Then we had, up month, down month, basically even here in May. So, but as you can see here, there's been a couple of times, there was 2 down months in a row, but we haven't had 2 up months in a row. And so it'll be interesting to see. So And 3,900, which I mentioned a little while ago as being like, a really important level for the S&P, I think. 3,900 and 4,000. And quite frankly, I think that the market's kind of, we're closer to well, actually, hang on. The 3950, right? At 39, roughly 3950, we're right smack in the middle of, go to that weekly chart, right smack in the middle of 4,000 and 3,900, which is kind of like the range, recently. And so, yeah, so here's a weekly chart. It's going to be interesting. The thing about the weekly chart and the monthly chart is they're not going to coincide, right? I mean, today's Wednesday, and it's going to be the end of the month. So the monthly chart's going to look like one thing, but the weekly chart's going to look like something else because it doesn't end. This week doesn't end until December 2nd. So anyhow, you can see these past few weeks have been a pretty tight range here. So if I'm not mistaken, this was the big rally off of the 7.7% CPI print, right? Like, and I still kind of don't get that, right? Because I mean, for one thing, inflation is like the number one priority of the Fed, so they say, is to get inflation down. And I mean, it was like, a year ago that Powell said that 5% inflation is not acceptable. So, Powell speaks at 1:30, and then the Fed Beige Book is out at 2. So it's going to be a wild afternoon. So, I mean, yeah, this market could end up at 4,000 or 3,900 today. If either one of those events creates any sort of, big buying or selling. So, yeah, Jim says energy's up 62% of the year. That's the big winner, and then obviously most likely, technology momentum stocks. I haven't pulled up like all the returns for all the sectors yet, but I'm just getting back into the groove of it. Usually have a lot of this stuff in my head, but I had a lot going on around Thanksgiving, family coming in town, and all that kind of stuff. I went to a football game, had a good time. Good Thanksgiving holiday. It's 80 degrees here and sunny today. Amazing, I know. We've had one little cold snap, so, but yeah, it's going to be, I can't believe it, November 30th. But, from year to year, everything varies. I know some of you guys are freezing, but it's amazing that we had a really mild winter last year. I'm hoping for the same this year. So, anyhow, there you go. I guess I could pull up, let's see, this is my chart with the trend lines on it, so kind of self-explanatory. And as I said, that MACD is on the verge of crossing over that I had up earlier, and so, but obviously, the MACD is obviously following the price, so you got a ton of overhead resistance here going into the end of the year. So every time I look at a chart now, I want to visualize where the end of the year is. And so it's difficult to, it's impossible actually to know whether they're going to be able to hold this thing up below this trend line, just around 4,000, or whether we're going to get another down cycle. But like I said, seasonally, and a lot can happen in a short amount of time. I mean, like over here. I mean, back over here in November, it looked for sure like things were gonna get smacked down, and then you get that CPI number came in better than expected, even though it's a terrible number, and that kills me. When you get a terrible economic number that's better than anticipated, and the market rallies off of that, but it's just one of those things. So. And so keep in mind, Goldman Sachs year-end price target is 3,600. You got the 50-day moving average down here at 3,800. You got the overhead resistance from the 200-day right there and downward sloping trend line. So it's anybody's guess how things play out. And what the Fed does is, and the funny thing is, it's not even what the Fed does. It's what they say. It's how the market perceives their path into the new year, because basically everything that we know is already priced in here, right? And quite frankly, I think, and a lot of other people that I read think that the market participants are being overly optimistic, and quite frankly, it's pissing off the Fed, because what they need is an economic slowdown and asset prices down and all this and that to fight inflation. So luckily they have the price of oil has come down considerably, right? And so that's something else interesting, Jim. So Jim says seasonally E-minis up 0.5%. Yeah, I mean these days 0.5% is like, one day's normal price fluctuation. So this year has been crazy. Anytime I see a move of like less than 1%, I'm like, oh, it's just random. I mean if the market doesn't move more than 1% on any given day, then it's just sort of random price fluctuation, because that's just kind of how it's been. A lot of just random price movement in that, and the real moves start with typically with over 1.5%, 2% moves. So it's been a crazy volatile year, even intraday. But what I was saying before is that the Fed needs they won't say it, but they need a recession. They need asset prices to come down. They need all of this crazy speculation in all sort of insane garbage, monkey pictures and bananas taped to the wall and all sort of insanity. And I mean this is a problem obviously they created, right? Somewhere I got a graph of annual money creation or whatever, and so it's pretty common knowledge that there's some crazy statistic like 40% of the money in circulation or that exists, US dollars that exist, have been created in the last 3 years or something. But anyway, they created the problem based on the overreaction, I suppose you could call it, to the pandemic. But anyway, oh, I guess that's my signal to wrap it up here. So it's going to be an exciting afternoon, and when I come back next week, we'll be able to talk about how things panned out. So it's good to see you in here, Jim. Hope to see you back here next week. Jim says most investors have never traded a bear market. He's been through 4 or 5 of them. Yeah, me too. I'm old school, so yeah, this current cycle, and the funny thing is, I've been saying it for years now. Reminds me a lot of the .com, because you just got these insane valuations on companies that on just ridiculous concepts for companies that would just got insane valuations. So what's that, Carvana? Carvana's probably, let me go to real quick before I wrap this up. Here's Carvana, right? So and the funny thing is that, I mean, look at this. What was this thing, like $375 up here? And so this is what reminds me of the whole .com thing. You had a stock that just had let me get a weekly chart on here. It doesn't really, there you go. So I mean this is why, and I've been saying for a while. I was saying probably before the pandemic that that everything sort of reminded me of the .com days, because just because these guys sold cars out of vending machines on the internet or whatever, and I don't know how many hundreds of billions of dollars their market cap was, but this is just one example of how the market, gets kind of crazy and, speculative, and then, parabolic run-ups typically end up looking like this. This is an extreme case, but there's lots of other ones too. So maybe next week would be a good week to go into this further. So like Zillow, right? And so, and so here's the other thing. When I look at these charts, I think of is like if you like blank out the parabolic run up and then the collapse. I mean, maybe Zillow was fairly valued over here, but this is what the Fed did during the pandemic. Like there was the pandemic sell-off in the market, and then they lowered interest rates to zero overnight and just threw trillions of dollars, into the economy. And the result of it is that, most of the stocks you look at, they went parabolic. And so, I mean, maybe if it wasn't for the parabolic run up, then you wouldn't have had, these kind of sell downs. But another thing Another thing to keep in mind is that a lot of these stocks are never going to recover ever, and so I think there's a lot of younger traders and investors out there that they look at something like this and they're like, oh well, I'm gonna buy a bunch of it down here because obviously down the road it's gonna. But back in the .com days, like these stocks, they just like the one we looked at before, GoPro, they come back down to earth after a parabolic run up, and then they just basically flatline for years, and then they disappear. They change their name, they get absorbed, they merge, they do something. But I mean, I look at the ticker these days, and there's so many stocks I don't even recognize, right? Because it was that big IPO frenzy a couple years ago, and all the SPACs and all that stuff. And so, back in the day, there was barely a ticker symbol on the tape that I didn't recognize, and it's kind of the opposite now. So there's still a lot of froth, I think, to be wrung out of this market at some point, but it'll be interesting to see how it plays out. Anyways, thanks for tuning in. I'm gonna wrap it up here, and I'll see you guys back here next week, same time, same place. Thanks for showing up and getting in the chat there, Jim. See you next